Guys, the biggest storm is about to hit the housing market, and I'm going to tell you how. As we know, mortgage rates have been through the roof lately, now a 7% due to the Fed's aggressive quantitative tightening. According to Redfin, sellers' time on market doubles from spring as buyers wait for prices to come down. Home sales continue to decline, and mortgage applications are at their lowest in 25 years. Which is very much understandable. The average price of a home is $357,800. Now, if we take this and put it into a calculator and going along with a 13% down payment, your mortgage would be around nearly $3,000 per month. The last time the Fed had a meeting, which was in September, they raised it by 3/4 of a basis point, which rose the federal funds rate to 3.25%. And now the next time the Fed meets is on November 2nd. According to this site, there's a 95% chance that the Fed will raise the federal funds rate again to 3/4 of a basis point. When this happens, mortgage rates could reach up to 8%. But other companies that forecast interest rates to be at the end of the year is 5.39%, and that is the National Association of Realtors. But then you have another company like Mortgage Bankers Association, which forecasted to be 5.50%. It seems like other companies, the majority of the other companies having around that 6.5%, 6%. Me personally, I agree. Historically, the fixed rate mortgage averages around 7.8% throughout history. But I could make the case right now is a pretty different environment. People have gotten used to lower interest rates. And also people have to worry about sky high inflation, something that we really haven't seen since the early 1980s. We also have the part of that with the fact of the lack of inventory we are now having in the housing market. Matter of fact, we've been having this issue long before. I want to show you guys a trend on how our inventory situation is only really going to get worse. You may think it's getting better, but no, that's only because houses are staying on the market just a little bit longer to the point where it actually adds to the overall inventory, not because houses are being built as fast. 1981 was around the time Paul Volcker raised interest rates to combat sky high inflation of double percent interest rates. And rightfully so, as soon as he did that, housing starts plummeted. Why? Because it became way harder for building companies to borrow money because of the sky high interest rates. Ultimately, this also will push the price out of buyers who could have afforded the house before the interest rates hikes even happened. Now, fewer home sales will make it way more difficult for building companies to pay off the loans that they borrowed. And this will cause builders to pull money away from their other operations. Now, even worse, a home builder with losses and reduced operating income is likely to see a reduction in its stock and consumer buying power. The next few months will be very tough for home builders, hinting at the fact that their building confidence is at the lowest level, record low levels since a while. Now, essentially, home prices still won't go down because we have an issue with the supply and demand. Now, supply and demand has been a big issue even before the pandemic. America was short 3 million houses. So I don't see how home prices going back down to pre-pandemic levels just yet, at least. But now we do have the thing with lumber prices, and people talk about that a lot. Lumber prices have dropped 26%, but I don't think lumber prices will really affect the housing market too much. It's like putting something in a rolling rock. It's not really going to stop too much. Maybe it'll hold it back a little bit, but at the end of the day, it's still inevitable. Now, with lumber, I think they're more focused on making multi-family homes as of right now. They're not really opposed to focusing on single-family homes. And even if they are probably most likely better off selling to investment groups such as BlackRock and all the other big companies. Now let's switch the topic back to the Redfin article. As we can see, fewer people search for homes for sale on Google, which is down 33% from last year. The seasonally adjusted Redfin Home Buyer Demand Index, which is a measure of requests for home tours and other home buying services, was down 31% year over year, reaching its lowest level since May of 2020. Touring activity was also down 25%. Last year around this time, it had an 8% increase. At the same time last year, mortgage purchase applications were also down 4.5%. So what does this mean, guys? Well, let's see it like this. Those who missed out on a 2 to 3% interest rates are really not that bad out of luck, because those people still overpaid and they waived a lot of contingencies. I'm not shaming people that got in on the lower interest rates. I'm just saying how it is. Majority of people that did get a house, they did overpay. It is just how it is. But here's what the Fed's most likely planning. I'm most likely assuming they plan to lower interest rates soon, but not in 2022, but in the next couple of years that is coming up. And when they do, you guys can get a shot again, hopefully in better market conditions. Hopefully building can actually ramp up, I hope, even though it doesn't seem likely as so far. But there's a trend. Typically, when interest rates rise high for a couple of years, low interest rates follow. But interest rates have been low since, well, the federal funds rate has been low since 2009. And the highest it did reach post-pandemic was 2.4%. So we enjoyed low interest rates for quite a while. Now, I want to show you guys this chart from Reventure Consulting. We are realistically in the biggest asset price bubble ever. The more interest rates go down, the more asset prices go up. And when interest rates went up, asset prices went down. Based on this chart, you can clearly see in 2008, it wasn't nearly as high as it is now. And that was something people consider as a pretty big financial crisis. The historical average is right around 200%. That's when like the equilibrium of everything, the interest rates and the asset prices. So to get to that number, he said we would have to get down to 40% to what it is now in the housing and stock market. But the scarier thing is with Credit Suisse, a huge bank that is in the list of global systemic banks, which means if that bank falls, it could cause global trouble. And we all know Europe is currently undergoing a severe recession, especially with the euro and all that other stuff. And realistically, it could spread to, America, because everything is all interconnected. But America is going to find itself in its own recession. We just don't know how hard it's going to be. But what really worries me is the personal savings rate being as low as it really is right now. It was sky high during the pandemic, but only due to the insane amount of stimulus that the government was giving out to Americans. The personal saving rate jumped from less than 10% in the years before the pandemic to all the way up to 26%. But now that number has dipped to as low as 3.5%. So Americans are currently spending way past their savings. And also we got to see as this piling debt that has happened. Credit card debt is rising at its fastest clip in more than 25 years. According to the Federal Reserve Bank of New York, Americans owe $887 billion on their credit cards, a 13% increase from a year ago, which is crazy. And the average credit card rates are at their highest level in 30 years and will probably continue rising according to Bankrate. But this is going to be the end of the video. I'm going to upload another video today, so make sure you guys like, comment, subscribe. If this video hits the algorithm, welcome, and